For today's main topic, we're going to be covering my top 10 tips for mortgage success. This is more or less a strong follow-up to my episode on HopeFilled Financial Footstep number 7, where we put a lot of emphasis on getting our mortgage paid off before retirement at the latest. Think about this. Mortgage, if you break it up and look at the French origins of the word mort, literally means death, and gage in French is going to be translated roughly to pledge. So mortgages are death pledges. More or less, the meaning of the word is saying I'm going to promise away my income through the rest of my life in order to pay for this dwelling. And some mortgages really do try to live up to that name. I've seen 45-year mortgages. Now, if you are 45, 50 years old and you take out a 45-year mortgage, you are genuinely making a death pledge. But I want us to be able to beat mortgages in their namesake. I want us to not pledge our entire income away, our future, our time, in order to pay for a dwelling. I want us to be able to own the roof over our head and feel comfort and peace for doing so. And that is going to be the foundational principle behind my top 10 tips for mortgage success. The first of which is keep your mortgage payment below 25% of your gross pay. If a mortgage exceeds more than 25% of your gross pay, you start becoming what is known as house poor. At 50% of your net pay, you're definitely house poor. You see, if the mortgage takes up too much of your monthly budget, the rest of your expenses are going to feel tight and you're going to feel trapped. And you're going to feel like you're in a crisis mode when there's a major expense on your home that isn't related to the mortgage, like replacing an HVAC unit or rotting siding. You're going to set yourself up for a much more affordable situation if you keep that mortgage payment at or below 25% of your gross pay, statistically speaking. Now, tip number 2 is strongly based in my principles for HopeFilled Financial Footstep number 7. Don't sign up for a mortgage that will run you into your retirement years. For example, if you're 20 years old, you can take a 30-year mortgage out and hit age 50. But you can't take your retirement account monies out until 59 and a half. So a 30-year mortgage in your 20s there will not run into retirement. But a 30-year mortgage in your 40s or 50s definitely runs into retirement. Why would you sign up for a mortgage that runs into retirement if your goal is to have it paid off beforehand? You might say, I'm just going to pay extra and it's going to be my plan to pay it off at an accelerated schedule so that I can beat retirement. But I think it makes more sense to set us up with a situation where even if you're not able to pay any extra because life happens, you're going to be able to achieve that goal and maintain appropriate degrees of freedom. If you have a mortgage that rolls into retirement, you're going to end up in a season where you're trying to accelerate the payoff when you could be retired. This season could have you considering downsizing in home to something that is smaller than what you had dreamed of for retirement. You might also be considering taking a large chunk of your nest egg out in order to pay off what remains on your mortgage. And depending on your nest egg balance at the time, that may also further delay your retirement as it may put you behind your retirement number. In essence, let's set ourselves up so that we have optimal degrees of freedom and are able to retire once we hit age 59 and a half or age 60. No matter what. Even if you think you want to retire later, like 65 or 70, it's very freeing to be able to retire earlier and not have a mortgage be part of what holds you back. All right, moving on to tip number 3. And that's going to be understand your down payment situation. When you're buying your first home, I think it's okay to go in with a very low down payment just so that you can get into the home ownership game. At the time of recording, and depending on the type of mortgage that you're getting, your minimum down payment is probably going to be around 3 to 3.5%. Now, ideally, you're bringing in a little bit more equity into the situation so that you prevent yourself from going upside down. And what I mean by that is you owe more on the home than what it's worth. If it were to go down in value, it's going to erase all of your equity, all of your down payment. Let's talk about why this is a problem. If your home goes down in value after you come in with a small down payment, you're upside down, and all of a sudden, for reasons outside of your control, you want to sell your home or need to sell your home. You need to relocate. Well, you're upside down. Your home isn't going to sell for what you owe on the mortgage, and you're going to be liable for the difference on there. And if you don't have the difference in your mortgage, well, you're going to be stuck in this home, even if you feel immense pressure to move. This was a problem that was very common during the 2008 housing crisis. So while it's okay to go in with a low down payment, you need to understand the risk that you might end up stuck if the housing market declines. The way you can mitigate this risk is trying to put yourself in a situation where you're very likely going to be able to stay in the home for at least 5 years, or going in with closer to 10% for your down payment. Now, while we're talking about putting a larger down payment on a home, let's talk about private mortgage insurance, PMI for short. Private mortgage insurance is an insurance premium that you pay for your mortgage lender. You're paying the premium to protect your lender in case you default on the loan. And by law, you're going to be paying this PMI up until you have 20% equity. Because someone out there figured that once you have 20% equity in your home, you pose a much lower risk to your lender. Now, PMI represents an expense that could be avoided if you had a 20% or greater down payment. I paid PMI on my first mortgage up until I refinanced. At the point of refinancing, my equity exceeded 20% of the condo's value, meaning that I no longer had to pay PMI with my refinanced mortgage. Getting rid of PMI is a great way to help accelerate your journey in paying off your mortgage and reducing how much goes to your housing expenses every month. Which brings me to one thing that's probably going to come up while you're getting a mortgage and working on your down payment, and that's going to be points. You see, a mortgage lender can sell you quote unquote points to reduce your interest rate. When you're coming in with the down payment, you're selecting how long your mortgage is going to be. They're going to be talking about your interest rate. And the points are a way for you to get that interest rate down. But the mortgage lender's not dumb. They're going to try to come out ahead no matter what you do, whether you buy the points or not. Buying points is effectively paying interest in advance. Instead of placing money into your equity with your down payment, you would be paying them directly so that your subsequent payments later put a larger percentage toward your equity versus interest. Again, points are just paying interest in advance, so they do not make sense if you're going to be in a home for a very short amount of time, or you plan on refinancing within a few years. You can do a break-even analysis to see how long you need to keep that mortgage in order to make buying points worth it. And you should know that the way that points are priced by mortgage lenders favor their making money on this transaction. They're a business. They want to make money off of you through this loan, and they're going to do it whether you buy points or not. And for that reason, and wanting flexibility, and when I relocate or refinance, I've by and large avoided points altogether. Points also don't make sense if you're in a situation where you're going to be fast tracking the payoff of your mortgage if you're in HopeFilled Financial Footstep number 7. In general, again, you got to do a break-even analysis to best understand. All right, enough about down payments. Let's move on to tip number 4, and that's going to be either have a good credit score or no credit score, but not something in between, i.e. a bad credit score. There are 2 ways that you can get a mortgage. Dave Ramsey's right that you can do manual underwriting, but you can also get a mortgage based off of your credit score. If your credit score is above 620, you're probably going to be able to get a favorable mortgage. So going into your first mortgage, at the very least, you can choose one of those 2 paths. I told you in the story, I tried to go the manual underwriting route because that's what I was told to do, but I didn't have the work history nor the payment history in order to make manual underwriting effective. My only avenue was to have a good credit score. And after you get a mortgage, you will have a credit score, whether you like it or not. So more than likely, any subsequent refinancing or mortgages that you have are going to be dependent upon your credit score anyway. Now, you likely know that I don't have credit cards, that I'm not a credit card person. So my credit score is entirely based right now on my mortgage payments. And in just having mortgage history, my credit score with 100% on-time payment is over 700. So I know it's possible to be playing this credit score game in the phase of life where I am, once you own a home, once you have a mortgage, and not deal with other facets of debt in an effort to get your credit score up. Now, if you have bad credit, you're probably going to have a very hard time getting a mortgage, and if someone's willing to lend you the money, they're going to be charging you a much higher interest rate, and that can be very detrimental to your financial future. It's a very expensive way to go. And regardless of which way you're getting your mortgage, you're going to want to shop around with lenders in order to see who can give you the best rate. Speaking of rates, let's move on to tip number 5, and that's going to be avoid adjustable rate mortgages for your stability. An adjustable rate mortgage, or ARM, is going to offer a lower initial interest rate right up front, which looks really appealing, but an adjustable rate mortgage is not a benefit to you. It is a protection by the bank. You see, the bank, the lender, is able to move your interest rate up after an initial period transpires, meaning your mortgage payment can have a significant spike. This was a big part of the foreclosure rate in the 2008 housing crisis. A lot of people had adjustable rate mortgages that came due, the interest rates spiked up, no one could afford their mortgages anymore, and foreclosures ensued. And I don't want that for you. I don't want you to feel trapped. You might say, well, I'll just refinance, but what if the market dips down like it did in 2008? What if you end up upside down? What if it becomes very difficult for you to refinance because of a credit score problem? What if you end up stuck with that super inflated mortgage payment? In most situations, I don't think it's wise to try to save on that initial interest rate by going with an ARM. And remember, we want to be exercising hope-filled frugality, the intentional practice of prudent economy. Having a fixed rate mortgage of any duration is going to give you predictability, and it's going to give you stability. It's going to give you confidence and peace. It's going to be much more frugal than an adjustable rate mortgage. Let's move on to number 6. Tip number 6 is to plan on staying within a home that you have a mortgage on long enough to recoup your closing costs. Most financial experts will tell you this is around 5 to even 7 years in typical housing markets, historically speaking. Even though lately, with the great bout of appreciation we've had in homes, that duration has been much shorter. But think about it this way. If you move very frequently and you don't hold on to any one given mortgage in order to recoup closing costs, you're simply digging yourself into a hole by paying those closing costs. You're incurring an undue drain on your income, which is why many financial experts recommend renting for short-term housing situations and say only buy if you're going to stay in the home long enough. It's both the recouping of the closing costs and being in a home long enough to likely have positive appreciation that gives people that 5-year number. All right, tip number 7. And that's going to be keep equity as equity, similar to how I don't want to use my retirement accounts for anything other than retirement monies. Yeah, there are rules that allow you to take your money out of a Roth IRA or an IRA in general for particular expenses ahead of 59 and a half. But that doesn't mean it's a good idea. You could be borrowing against your future and setting yourself up for not having enough in retirement. Similarly, as we are building equity with our journey to be mortgage free by retirement, it makes sense to maintain equity as equity in most situations. When I moved from Utah to Kansas City, I kept all of the equity that was in my condo as equity, and I applied all of it that remained to my down payment when I relocated, when I got my third mortgage. Doing anything otherwise, having a cash out refinance or taking a good chunk of your equity out for consumption purposes may very well be a step backward. Now, you can do the math and say, I'm still on track to be mortgage free by retirement, but it will increase the length of time you have a mortgage and increase the length of time that you don't have an increase in your degrees of freedom with your work and your budget situation. Tip number 8 is going to be refinance when it makes sense. And this making sense thing is going to be predominantly for me based off of the break even. When you refinance, you're basically getting another mortgage. That's why I said when I moved to Kansas City, even though it's my second home, it's my third mortgage. And anytime you get a mortgage, there are going to be closing costs associated. And hopefully your refinancing is helping you put more money per payment toward your principal than towards interest, i.e. you're refinancing to a lower interest rate. There might be other reasons why you might want to refinance that could give you a higher interest rate. One example would be to get rid of PMI, even at the cost of a slightly higher interest rate, if the result is a lower mortgage payment for you, and you're very concerned about current cash flow problems with your monthly budget. But I want you to, even in that scenario, look at a break-even analysis. In the story, I told you that my refinancing broke even in 2 months. The difference between how much I was paying in interest with my first mortgage and how much I'd be paying per month in interest in my second mortgage was able to recoup the closing costs in only 2 months. Yeah, and that break even made it a no-brainer, but you need to look at a break even that has a longer time horizon, say 1 or 2 years, and ask yourself, is it worth it for you? Or is it going to make more sense to apply disposable income toward the principal on the mortgage in order to shift the ratio of the mortgage payment? Let's actually dig into that a little bit more. If you're on audio only, for the video component of the podcast, now I'm looking at a spreadsheet that I made in order to calculate mortgage payments. Let's consider an example with a $200,000 mortgage at a 5% interest rate that lasts 30 years or 360 months. The resulting mortgage payment before you add in anything that would be going through escrow is $1,073. Now over here I have a black table and I have a blue table. The black table is the default, as if you did nothing different with the mortgage and you made all your payments on time. Meanwhile, the blue table covers what happens if we apply an alternate payment. For this example, let's say that we paid $1,200 a month instead. In total, over the life of the mortgage, doing so from the get-go will save over $44,000 in interest. You'll also notice that it changed this graph down here. The green represents the percentage of your payment over time that gets applied to principal. Meanwhile, The red represents the percentage of the mortgage payment over time that goes toward interest. And here's something else. The red and green chart shrink in length by over 6 years by paying a little bit extra on the mortgage. We were able to cut over 6 years out of 30 years from the mortgage by paying less than $200 extra toward the principal. While we're talking about this, I want to show you the benefit of having a mortgage that doesn't quite hit 30 years, even if that shorter mortgage has a higher interest rate. Let's say, for example, we wanted a 20-year mortgage and that the interest rate was 5.5 instead of 5%. Well, if we change how long the mortgage lasts in the calculator, you're going to see that the percentage of green in the graph below is much higher than it was with the 30-year mortgage, and the interest that's paid significantly dropped. By how much, you might ask? The 30-year mortgage cost $186,000 in interest over the lifetime of the mortgage. Meanwhile, the 20-year mortgage only cost $130,000 in interest, a savings that exceeds $50,000. Now, you may have noticed that the monthly payment for the 20-year mortgage is now over it's almost $1,400. A shorter mortgage is going to result in a higher monthly payment. Even though more is going to principal, it may make a particular home more unaffordable. And for completeness, let's go ahead and change this 20-year mortgage to a 15-year mortgage, which jumps the payment up to over $1,600. A change that's much more expensive than $1,000 a month, but gets your interest over the lifetime of the loan below $100,000. In this particular example, I want you to understand that even though a shorter mortgage may look more unaffordable, it's going to save you an interest in the long run, and it's going to allow a larger percentage of your payment to go to principal right away. I mean, in this example, the first payments are around 45% going to principal on a 15-year mortgage. Compare this to just over 20% going to principal on the 30-year mortgage with a 5% interest rate. If you're looking at getting a mortgage or refinancing here in the near future, I highly advise you to understand these trade-offs. Play around with a calculator tool like this. Understand how different lengths and different interest rates are going to impact you so you can make the most hope-filled decision for your future. Now, on the internet, there are arguments that are made to always get a 30-year mortgage regardless of how old you are and then pay it off as if it were a 15 or a 20-year mortgage. And this brings me to tip number 9. If you're trying to accelerate your mortgage payoff date by putting extra towards your principal every month, you got to automate it. Automating your extra principal payments is going to reduce friction between you and actually paying your mortgage off early. We saw in the recent example that less than $200 for the illustration saved over 6 years. And automating that means that you can treat it as a lump sum payment that is a higher demand on your budget, as opposed to manually going in and paying a different amount toward your principal every month. An extra amount that's over and beyond your obligated mortgage payment, naturally. And I do believe that simply automating extra payments toward your principal every month is the best way to accelerate your mortgage payoff. There are a lot of scams out there that talk about doing a timing system or breaking your payment up over different months and paying someone to do that for you because they have the secret. The simplest way to get your mortgage paid off faster is simply put a little bit of extra money toward it every month. That's something you can do yourself. You don't need to pay somebody to try to help you accelerate your mortgage payoff. This brings me to my final tip today for mortgage success. Tip number 10, don't go backwards. To the fullness that you can, avoid cash out refinances, avoid HELOCs, and avoid reverse mortgages. We want to be mortgage free by retirement at the latest. Anything that consumes our equity or makes equity consumable, like a cash out refinance, a HELOC, or a reverse mortgage, is simply going in the opposite direction. My mortgage on this home recently sold from one company to another, so who I'm paying my mortgage payment to changed. And since this new company has taken over my mortgage, I've gotten a bunch of spam emails from them saying, hey, have you considered a HELOC or a cash out refinance? Think of all the cool things you could do for your home if you were to tap into the equity that's appreciated and push it into home renovations or vacations or freeing you up from debt. And it kind of drives me crazy because I don't need to take a cash out refinance. I'm under no pressure to do that sort of thing. And they're pushing it just because they know they're going to make more money on me if they can have me borrow more money for a longer period of time. That's all they're trying to do. It has nothing to do with a benefit for you. Are there times when a cash out refinance or a HELOC makes sense? Probably. But by and large, it's something that I want you to exercise only as a last resort if you absolutely need to. For me, other than absolute tragedy occurring, such backwards motion on my mortgage is taboo. With that, what did you think of my top 10 tips for mortgage success? Let me know in the comments below. And let me know if I missed any major tips for understanding mortgages and being successful with mortgages that you have exercised in your history. I love it when we share our stories. And with that, until next week, until next Tuesday, budget bravely and enjoy your hope-filled financial future.